All right, so, we're all about dividends here, right?
Yeah.
And global equities. Well, today we're going to dive into a brand new ETF that's trying to kind of bring those two things together.
Yeah, and it's interesting because this Nicholas Global Equity and Income ETF, GIAX, it just launched like last July.
Super new.
Really new. And their goal is to provide these monthly dividends, which is ambitious,
Very ambitious.
especially for an ETF, right?
Yeah, monthly payouts. I mean, that's going to be like music to any dividend investor's ears, but how do they actually plan on making that happen? What's the plan?
So they've got this two-pronged approach, right? So the first part is all about global equities. They're investing in other EPFs. It's like a basket of ETFs.
So rather than pick individual stocks, they're saying, hey, let's go for broader exposure.
Exactly.
And we see that in the fund summary in the pitch book too, right? This global approach.
Absolutely, yeah. And they're not just U.S. focused either, which is interesting because the pitch book actually mentions they want like 4 to 6 index ETFs, all equally weighted, but at least 2 of them are primarily focused on like foreign securities.
So they're casting a pretty wide net here,
Yeah.
trying to capture different, opportunities across the market. Makes sense. Okay, but then there's that second prong of the approach. This is where I'm like, okay, this is interesting. They're using something called index call spreads, and they're doing this daily, selling them on U.S. equity indices.
Yeah, so it's interesting, right? They're really diving into options here as a way to, I think, generate that income, that consistent income stream that they need for those monthly dividends. And this is core to, their whole approach. It's in all 3 of the documents that you shared.
Yeah, I got to be honest. When I hear index call spreads selling daily,
Mm-hmm.
it's a little bit, Wall Street-y.
Mm-hmm.
So can you break that down? What are they actually doing? And then how does that actually generate that income?
Yeah, absolutely. So essentially what they're doing is selling what's called a credit call spread. So that means they're selling one call option and buying another one at a higher price, but they both expire very quickly. So we're not talking about a week, maybe a month out, and that generates what they call a net premium, and that's the income.
Okay, so they're making these options trades every single day.
Every day.
That's a lot of activity. Is that typical?
It's not typical for your, typical ETF, your kind of buy and hold strategy. This is more common when you see these actively managed funds, which, GIAX is, and that's how they're going to try to maintain that income for those monthly distributions. But, with that activity comes risk too, right?
Yeah, because it's active.
Yeah.
So that means they're relying on their portfolio managers to really know what they're doing, and there's no guarantees there.
Exactly. You're relying on their skill set.
Yeah, so speaking of risk, if the market, let's just say, takes a downturn, are those options premiums really going to offset any potential losses that they might have in the underlying ETF holdings?
I mean, that's the million-dollar question, right?
It is.
And it's something that, GIAX even acknowledges in their summary prospectus. They say, hey, even with this strategy, we're not immune to losses.
So there's no magic bullet here.
There's no magic bullet. You're not going to completely avoid losses, even though these premiums can help.
Right, it's not a hedge.
In those small fluctuations, they may not be enough to fully offset the losses if we saw a big downturn.
Yeah, so it sounds like they're walking a tightrope, trying to make this consistent income from these options trades. But also, still, you're exposed to the market.
Exactly. You're still exposed to the market.
But understanding that balance seems pretty important.
Absolutely. Yeah, absolutely. It's a delicate balance they're trying to strike here.
So, okay, we've established, GIAX, they're all about these credit call spreads, but how do they actually make money from that? What are they hoping is going to happen?
So their whole strategy basically hinges on this concept called time decay in the options market. And it sounds kind of complex, but it's actually a pretty straightforward idea.
Time decay? All right, you're going to have to explain that one.
Okay, so imagine you have a ticket to a concert, right? And it's, let's say, a week out. As we get closer to that concert date, the less you can probably sell that ticket for. It's all about time running out.
Because, yeah, after the concert, it's worthless.
Worthless, exactly. And options work similarly. They have an expiration date, that's it. And as we get closer to that expiration date, the value of that option decreases, and that decrease is what we call time decay.
Ah, so they're trying to be on the right side of that countdown clock, hoping it expires worthless so they can keep that premium.
Exactly. And because they're selling those credit call spreads with very short expirations, like we're talking a week or a month out, they're really trying to profit from that time decay. It's like collecting rent on, a slice of the market, hoping that it doesn't move too drastically before that option expires.
Yeah, and they actually, the pitch book shows this visually. They have a little chart in there.
Oh, yeah.
And it's interesting. It shows how, if you do these short-term credit spreads more frequently, so doing it weekly, the idea is that could potentially generate higher returns versus if sold a longer-term option less frequently.
It's an interesting trade-off. You're basically, they're making a decision to go for a faster income, smaller income hits more frequently versus maybe a slower, larger payout later on.
Right, but with higher potential return, though, often comes higher potential risk, right?
Yeah.
And they do acknowledge that in the pitch book, they even say, and I'm quoting here, market-related risks to performance, because even though they're not holding those individual stocks directly, what those underlying ETFs do still makes a huge difference.
Oh, for sure. And it all relies on, I think, a key part of this is their portfolio managers, right?
Yeah.
And we're talking about active management. These guys are making decisions, I imagine, constantly. It's not just setting it and forgetting it.
And active management usually means higher fees, right?
Usually.
Which is something else to think about. And they do mention in the summary prospectus, their expense ratio is 0.97%.
Okay, so that's, yeah. That's not insignificant.
It's not nothing.
Yeah.
So, knowing all this stuff, the global equity piece, the option strategy, the risks, the fees, who is GIX a good fit for? Who should be picking up the phone right now and saying, get me in?
So I think given the focus on income, this feels like something that would appeal to maybe retirees, people who are looking for income now, not growth later, right? Maybe people who are nearing retirement who need something to kind of supplement what they've already got.
Yeah, monthly distributions would be attractive for sure, but it sounds like, this isn't for someone who's completely risk averse, right? They're going for a very specific kind of investor, someone who's, understands how all this works.
Yeah, they are going for a very specific type of investor, absolutely. This is a less conventional approach. It has a different set of risks and rewards. If you're someone who likes, set it and forget it, passive, if options make you a little squeamish, then this might not be the right thing for you.
And they even say that, right, in their materials. It shouldn't represent, significant portion of your portfolio.
Yeah, it's a good disclaimer. It's like, hey, this is one tool.
Right, this is one tool in the shed.
In your whole shed.
It's not the whole shed.
Don't buy this and then that's it, you're done.
Don't put all your eggs in this basket.
Exactly.
Yeah. But it is interesting, though, how ETFs are changing and trying to meet all these different needs.
For sure.
But it's also I think a reminder that there's no guarantees in the market.
Absolutely not.
And especially with one that's so new, there's no track record to even look back on.
No crystal ball.
So, it might check a lot of boxes for those income-focused investors, but due diligence is key. Make sure you really understand what they're doing and then, make sure it works for your goals and how much risk you're willing to take on. But there's one more layer to this, right? We talked about, this idea that the performance of GIAX might look really different from just a typical, global equity fund. Because that's what's wild, right? It's not just about the income, but it's how does that performance actually stack up against, if you just went with your typical global equity index fund?
Yeah, I mean, that's why I think it's really interesting is their performance could look really different from that standard. And it's largely because of that options overlay that we've been talking about.
Okay, so walk me through that. How could things look different?
So remember, they're selling those call options at a certain price.
Right. They're kind of putting a cap on how much they could make on those ETFs.
Exactly. They're capping their upside potential in exchange for collecting those premiums. So if the market just shoots up, GIAX is only going to benefit up to that strike price they sold at. They miss out on all those gains beyond that.
So it's like a speed limit on their returns.
Yeah, exactly. That's a great way to put it. And then on the flip side, if the market tanks, those option premiums they collected, those might not be enough to cushion the fall,
Yeah. So it's really a trade-off. They're giving up some of the potential for those huge wins in exchange for that income and, a little bit of downside protection.
Totally. Yeah. And that's why it's so important. Like we were saying, investors know your risk tolerance, know your goals. They're making a bet on the market, and you got to decide if you're comfortable with that.
Right, because it's not just picking an ETF at that point. It's picking a strategy.
Like a whole strategy.
Yeah, and speaking of, the pitch book did mention, I think they're aiming for a target income of 15–20% annually from this.
Oh, wow. Okay. So, which is significant.
That is significant, yeah.
Yeah.
But I guess, take that with a grain of salt, right?
Yeah.
Because past performance, you never know.
Of course, yeah, especially with something this new.
Brand new. So the actual returns, they could be higher, they could be lower. Who knows? Depends on the market, depends on those ETFs, depends on their options trades.
Exactly. It depends on everything. That's
Yeah,
investing for you.
that's the market, baby.
Right.
So, okay, we've covered a ton on GIAX. Someone's listening to this, they're interested. What's the big takeaway for them? What should they be thinking about before they, run out and put all their money in?
Well, I mean, honestly, GIAX, it's a really unique way to try to generate income. It could be great for the right person, but it definitely has risks. So do your research, understand the strategy, and then maybe most importantly, talk to your financial advisor. Like, make sure this really fits your own situation.
Couldn't have said it better myself. All right, everyone, thanks for joining us on this deep dive into GIAX. Hopefully, you've got a better sense of how it works, what the potential is, but also those key questions to ask before you make any decisions.
Absolutely.
And until next time, happy investing, everyone.